Greetings, market rebels. Welcome to this week's macro measure, excuse me, combined with the sector situation video. It is Sunday, April 6th. It's just in front of 9:30 a.m. here on the East Coast. I'm Wayne. Let me just apologize in advance because I'm not feeling well. And so we're just going to do the best we can under these tough circumstances everywhere you look. I'm sorry about that. It's just the way it is right now. I don't have any control over the timing of this, unfortunately. But anyway, here is our trusty disclaimer for Market Rebellion. Here is our trusty intellectual property rights notice from Market Rebellion. Last week, this is the slide we went with. I'm not even going to really hit on much here. I'll let it come up in the stream of consciousness that's about to take place just because of circumstances, or I should say just due to circumstances. But essentially, I think just in summary, I look back and just before the top got put in, we were fortuitous in our timing where we were able to get the Esterhaus warning, which we used from Hill Street Blues, just kind of a joke, but we got that and the DEF CON going, which are basically the same thing. But as I've said, there's maybe slight differences. And so that was fortunate. You just never know if you're going to be way too early or, you're going to be too late. And it was fortunate, but I think I skipped a lot of the building risk stuff because of the length of the video. It's already a long video, and then when I start doing a bunch of tab checks in my browser with 30 different 30 different tabs, a lot of people really hate that. And some people, there's probably a small minority that really like it because it helps them, I think, respect the risk. And I know I sort of come off that way as really a risk-focused person. Um, but that's because my motivation is to not see people work so hard to take trades, build up some really good profits, and then have them taken away very quickly, like we've just seen happen in the market to a lot of folks, which is just really unfortunate. A long time video watching sadists that have listened to me, I should say masochists that have listened to me, they know that I'm kind of lean that way, so that I'm really concerned about the risk side and try to keep a really good appreciation for risk. And it's not an easy thing to do because when the powers that be are really pulling every lever to goose equity prices, uh, and providing liquidity beyond almost beyond comprehension as a big part of doing that, it becomes easy to forget about risks. It really does, I think. So anyway, that's really my basic message is just that uh, I just think you got to have a healthy respect for risk. We tried to do that. One of my points this week is that it seems like some emails I saw come in during last week, some folks maybe didn't get that. I don't know if they're all part of the services. I don't know if they watched the video. I just feel bad though that they didn't, the weekend video, I should say. I just feel bad that people seem to be, uh, I don't know, feeling like that they weren't apprised. I thought we tried to do that, at least. So I guess it didn't work out as well as I hoped for. But I'll just move on. So here's this week's slide, and it's really just you can read the top line there. I left the other one there from last week. So the bottom line for me is that it's another trade what you see. Good cases can be made for rally or extended selling, so expect volatility to persist. You're inside of a volatility maelstrom, a risk-off volatility maelstrom, and I'm not detracting from what anyone else is putting out there, but I still see a lot of people out there in the former Twitterverse, just they're just continue to find every reason to be a bull, and this might not be good for us to get in terms of getting a bounce. I think I made that case recently where just I feel like there was a lack of respect for risk and other factors that people were just I don't know, just kind of looking past and talking about how sentiment and oversold readings were already in place, and this should produce this, and a lot of times it does. I mean, there's a really good long-term track record for that stuff, but the overriding issue to me has been the uncertainty, right? And I think all the folks that have been in here for a while know that I tried to harp on uncertainty, regardless of being pro or con Trump and his policies, just the uncertainty that they create. And he may very well be willing to deal with that. The fact that the stock market's taking the hit, it seems like he is, uh, which is a real reversal, I think, from his first term, just on the record. But in my way of looking at it is just that it's something I learned early. You know, people long time successful investors would comment about that. Well, we have uncertainty right now, and that's what's hurting the market. And it came up quite a bit. And so when you have that, I do think there's been this poor performance from the market when there's major macro uncertainty. That would be my take. Now, I don't have empirical proof of that. I'm just saying that's what it seems like, you know, for me, from memory, anecdotally. So that's been my one of my pillars, if you will, as to why there could be problems, is that it may be a great policy in the long run, but it sort of disrupts the what's been happening now for the longest time. You know, I would say for this a quarter century, roughly, at least, if not longer, and in different ways. So that's been my issue, is that people don't really know the ultimate outcomes. They don't know uh, when those ultimate outcomes may be arrived at. So it does create that, and it gives folks a good reason to begin to sell that have done very well, right? It gives folks that are in an overvalued market a really good reason to sell. And so it also, selling begets selling, technical selling begets more technical selling. People being offsides and overly leveraged begets selling. Everyone long essentially the same, just to oversimplify it, everyone long the same names, that's not good with that high concentration. That means when people are forced to liquidate, they're liquidating a lot of the same things, and then it just creates a cycle. So this is just spouting off, but stuff that all of you have heard before from me, probably over the course of time, my colleagues at Market Rebellion, the folks all over the place. This is just this basic stuff. So I think it's I'm not discounting what people are putting out there. I'm just saying, I think to be really confident that you can make a prediction, not knowing what's next, that to me is not something I can do. So I'm sorry to disappoint everyone, which is not what many want to hear, but I'm sorry to disappoint everybody. But I'm not in the business of trying to look like I'm a genius, or I'm this savant, or whatever, an oracle or seer, or whatever the case may be. I think that being a short-term trader requires great flexibility, mental flexibility, and so you're better off, in my book, and I've said this many times, just not buying into this, that, and the other thing, and just trading what's in front of you, and focusing on that. And just what helps you to do that, I think, is framing where you are. And our framing changed a while back because the market wasn't really behaving and acting as well as it was. So we started talking about Fibonacci retracement levels and where there was confluence and things like that. So I'm not here to say we predicted this, that, or the other thing. Just saying, if you notice where the focus of the videos go, where they do go versus where they could go, that kind of tells you, I think, what I'm preparing for or thinking about myself in terms of what scenarios are likely to play out, what we have to be concerned about. And I think when we did feel as though the market was acting well, we did lean more towards upside potential. And when the market started to hesitate, we talked about how the market was getting messy, and then the market deteriorated. We started talking about downside. So again, it's really all about the conditions as best as I can make it. I'm not trying to do anything special other than say these are the conditions. I try to look through the market window that I've developed for myself, the technical window I've developed for myself. And I do that as best I can, try to be objective about it, and just take my experience into consideration. And I try to, try to do the best we can for folks that watch the video. So here's my take, right? Here's my assessment of where we are. I think last week we talked about a corrective phase, and we were either going to see more, or there maybe be a double bottom, and they would try to do something. I can't even remember, to be honest. But those are just the scenarios, right? We're talking about the tactical. What do you do about this? I don't like to see people get uh, thrown a curveball that no one's mentioned to them. So I try to mention the most likely scenarios, not necessarily all of them, but the ones that typically show up the most, which are, double bottoms and similar lows, slightly higher low, slightly lower low. Double bottoms are pretty prominent as an example, but things I think things just got worse. I think we harped on the NVIDIA story really being undermined, and we didn't really go into details. We just said that that continued to build, and things like that. And so I think when you take the leadership being knocked out, and so on and so forth, the way that things became defensive, the leadership sector is not behaving as well, all that mixed in, and you get what we get. And now it's taken on it, as it often does, it's taken on a life of its own, right? You're in a situation where you may as well, as we used to say during my floor days, throw your sheets out the window. You basically have to trade on instinct and discipline. That's the moment we're at right now, and it could persist. It just obviously depends on what comes our way next. But in other words, you just really can't go by the playbook. You can't just say this is exactly what I'm going to do, because you're in the middle of this. I'm calling it I often do, volatility maelstrom. So if you're in this, right, how do you, it's even more chaotic than usual. So it's very hard to make predictions. I just know that when you trade, with discipline, I just know that when you trade with discipline and a healthy respect for risk, and you're willing to be flexible in volatility, and you really roll quickly and trim quickly and these types of things, you can still do quite well. If you really feel like you've caught a short-term bottom, or a relief rally top, that's fine. I still would recommend that you consider a quick trim. And what I mean by that is, just let's say you're a 10 contract trader, you sell, you get a nice little move in your favor after you enter, you sell two or three at most, and that for a nice little profit. And that way, if it does reverse on you psychologically, if it goes back to where you got in, you get out of the balance of what you had, and then you reassess. That way, you still maybe eke out a small profit, and keeps you psychologically positive during what can become crazy times. So I know I'm soapboxing a little bit here, but I just wanted to just mention that we did what we could to try to get folks to prep for what transpired, not knowing if it would, just saying we try what we could from the feedback we get. As many of you know, I'd rather do, hours long videos on different things at the end of each week, and then people could just watch what they want. But it's just not in the cards right now, so I can't do what I really prefer to do, to try to help out. Anyway, unfortunately, that some folks didn't get the messages. It's very clear that risk off is dominating, and this is all about my regret, right? Because the missed hedging opportunities, I hate to see it. Ryan hates to see it. Greg hates to see it. It just, I hate to see this, where people just, I'm not saying that we were like, it's not about, oh, we think we were right. It's just that uh, a lot of you heard me talk about the collar. So I'm going to stop sharing this, and we're going to get into things. But yeah, I just had to cover a few things there. Let's do a stop share briefly, and then I will shut this down, hopefully, and hopefully shut it down again. And so I'm going to go to something. I'm going to go to my number. What screen is that? Number two right now. It's number two screen. And so I'm just going to show everyone this. And let me get let me see if it'll give me what do I want here? Well, I don't know if it will let me do that with annotation. I don't know if it will. Well, I guess we'll see. So I'll try to do the annotation right now, see if it lets me. No. Okay. Well, we're skipping over that. You're going to have to rely on my pointer. So this is even more basic than the collar. Okay, and a lot of you heard me talk about the collar. I won't even go into the collar again. I know everyone's ears have just glazed over along with their eyes, but here is a near term in the money call in Apple, right? This has got about 11 days of days till expiration. You can see the delta column, it's nearly 70. We'll just round it. Okay, if you look at the front week, the same strike, it's 72. Very similar in delta. So what I'm getting at is as long as you are trading something that has an expiration in front of it, something that will expire sooner, you always have a hedge as long as the liquidity's adequate. What do I mean by that? Well, if I were long 10 of these Apple 17 April 175 calls, I've got net about 700 long deltas, right? So what it could do is turn around. If I start getting worried at any time, I could sell 10 of those Apple 11 April 25 175 calls because the deltas are almost the same. This puts me in a calendar spread that I'm long, but it makes me virtually delta neutral, which means that as the stock drops, I'm not getting hurt. Okay. And I'm not a big fan of calendar spreads on for offensive purposes. But calendar spreads, in my mind at least, really are great defensive strategies to use because you can neutralize your delta very simply. And my argument is that when you start to see this stuff shaping up in the market, I think it was clear that the market wasn't acting as well as it had been really about almost 2 months ago at this point. After it topped out, you could start seeing it wasn't itself. It started to have issues. These tariff things started to become a little bit more to the forefront. Like this is on the way. There were certain announcements made building up to certain things. And again, when you have an overvalued market, historically, the valuations of forward PEs, whatever you want to say, it was up there. I don't know exactly who's got the best number for that, but I do know that it was quite elevated from historical norms. So when you get the uncertainty factor creeping in and you have rates that probably need to be lower now, sort of persistently high, and you know really everything's based upon this flow of money, this easy flow of money or flow of easy money, then you know that that could really monkey wrench things a little bit. Not that it will immediately, but that it could. So I think liquidity maybe is the most important factor these days, the way these markets operate. And with liquidity not being as good um, as it was when Trump came in theory, the liquidity wasn't as good. I won't even go into those reasons why, but that's the impression I was left with. Anyway, this is the simplest thing I can share with anyone. If you didn't catch other things that we tried to convey, I'm sorry about that, but this is about as basic and easy as it gets. And I've always said this, but if you start to see all these things popping up, that's when you have to acknowledge that, okay, this is maybe a time to hedge. And if you don't want to bail out of your investments, your longs, that's fine. I get it. And you're probably going to be right, but to not bail out of them a lot more than wrong. The only problem with that is you can really open yourself up to such a really quick give back, which everybody hates. This kind of a drawdown is horrible. So when you get that concerned or you realize maybe you should be that concerned, the market seems like it's getting that concerned, you can always hedge this way. And you're going to need to unhedge if the market finds support and starts working its way up. But when you get the sense that the market has cleared out of that danger zone, if the worst thing that happened is you didn't really make a lot of money when the market was in the danger zone, that's really not a terrible thing. Okay, you do have to unhedge this, but it's not a terrible thing. So just go learn about this if you don't know from Bill Johnson and the rest of the guys at Market Rebellion, because this is simple and you'll say, wow, I think you'll say, wow, the calendar really is great as a defensive strategy. I won't even go into all of it, but you can actually make money if the stock then drops precipitously. You just have to take off the trade once you get to the strike, in this case, the 175s. That's the point at which you can't play games and you got to get out. Anyway, just something to think about. So let's move on from that. Let's move into the charts. And what I'm going to do is talk about just big picture stuff because that's it. That's all I really have the time for. And it's all that I really uh, think matters at this point anyway. Because if this does persist, it could really get a lot worse. I hate to say that, but I think it can get a lot worse. And so what I did was on our simple charts from last week, I already started mucking them up. But let's take a look at the bigger picture. I'll start out with spiders, bigger picture. So there's my support line right there, and we're looking at a monthly chart. And this has been going on ever since the bottom in '09 and ever since Wall Street was prosecuted for all their financial. No, I'm kidding, of course. Um, Remember the clawbacks? Oh, that's right, they didn't happen. So things only got more ridiculous since then, and that's what produced this incredible run. Mainly, right, liquidity and basically all the mistakes that people made being hidden at the Fed. So we get this liquidity situation, and it's been driving equity prices probably since time immemorial, but it's also been really turboing them since the '09 lows. Anyway, this is where support would come in on that long-term support line, this purple line right here. And so if you think that we're really in the midst of something even larger that's going to create bigger problems, I would say there's unfortunately room to fall. Now, I think the good news about it is if you come into the daily is that you're not going to like it and you're going to say, how's that good news? Probably, but right, the good news is that that line comes in here. I'm considering things like this kind of like an overdone situation if you want to know why the line's not on the bottom. But if you came into there, you'd only have another all the way that is and retrace this whole thing in the SPY. You would only have another 20% to fall, which is terrible. But you'd still be able to maintain the long-term trend is the point. That's what I'm getting at. You still be able to maintain the long-term trend. Now, I'm pretty sure we were going for about 511 in SPY to 515. And the bad news is that they shredded right through that, unfortunately, by at least 1%. The lows were 505. Usually, when you shred right through, I think what should have been a pretty good level that easily, that is not normally a good sign. Now, it could just be obviously, right, it's overdone, but at the same time, it could be that there's more weakness coming. And what we did note up here was that the lack of a really strong bounce relief rally type action that really portended if we didn't do more than that, we'd roll over probably hard because the buyers just weren't able to muster the normal, let's say, gumption to go long that they normally do in a bull market or in bullish phases. And that didn't happen. And now I added the 500 and I added the 1000 day to this chart. And so we came down to the 500. So that's a pretty big area. It looks like this gap that I don't have circled is filled at this point. But unfortunately, the 1000 day is down here at 463, and the we have other gaps in the SPY that were left once this whole thing started. And so, you know, this is, you might say, well, who cares? That's not going there. But as many of you have heard me say over the years, I start paying attention to gaps when things are really starting to uh, fall apart. That's when they're returning back to these gaps left that are now on the downside, and the way that it's doing it, that's what I would start paying attention to. Now, the problem is, right, that things are horrendous in terms of sentiment. So let's just skip over to there and come back. So you can see that you can see the market breadth is horrible. I mean, the readings have just absolutely nosedived, right? And it's almost in every way. I'm not even going into the details on it. It's not worth it. It's so obvious that the market had well, let's make the case very, very quickly. Look at these sectors that we typically check out, and it's risk off, right? It's basically massive risk off. And a lot of this is probably starting to become forced selling, things like that. So you're in the middle of something that is, not extremely rare, but relatively rare, where you're getting that kind of horrendous performance across the board, complete risk off. You're basically on the verge of the spies registering a bear market. I believe the Qs have already registered one. So, the way that a lot of people like to define them, and so this has the potential to get even worse. Now, I would say that given where sentiment is, given where the fear greed index is, given the oversold ratings that we've got right now that are relatively, again, relatively rare for SPY. You don't see things this battered for this long in the short run. So I could see why a lot of people are saying, "Oh, we're due for a bounce." I get it, right? But as we often say, if you really believe there's a bull market that's going to keep unfolding for years, then you don't need to really catch the falling knife, because once things really start to improve and start to lift back up, that's when you can really start getting more aggressive and feeling like the market may have bottomed. There may be signs of a good tradable bottom, and we just haven't seen it yet. So if you want to, though, you can make the other side, the case on the other side. The other side is, from what I'm gathering, there's massive amounts of CTA selling that's triggered again. They're not done. I think they just flipped long back in here in a big way, and now they're really getting crushed, and now they're going to flip, get out of they've been getting out of their longs, but now they're going to flip to short aggressively. So there could be a lot of weight on the market in terms of that. Let's not forget to factor in the news-making administration that's in the White House right now. That anything can happen at any time. And that's another thing I've been trying to harp on, just that you've got to be so disciplined in these markets, because you just don't know what you're going to walk into the next morning or after a weekend. And like I said, it could be very good in the long run what is happening here. It could also maybe not be so very good. But the bottom line is, it's in the short run, it really upsets the apple cart that's been in place on turbo for the last, say, 15 or 16 years. And I think that's a big part of this whole thing, combined with other factors, is that it's just not, it doesn't seem to be that you're getting more of what we're all accustomed to. And it is good in a sense, and I'll pull this in, but we'll look at DXY, right? The dollar, in a sense, in terms of trade, um, right? This should help American exports in terms with cheaper dollar. And then in terms of TNX CGI, we've got that, and you can see the yields are plunging here right now, right? And you kind of have this head and shoulders developing in there. That if that does kick in completely and follow through, you should be heading lower. 10-year yield going lower. That's a good thing. I mean, the neckline is pretty much broken. I would put the neckline right about there. Pretty much broken, and you're on your way down. Now, there are false breakdowns. In this case, we're charting a yield, so it's kind of a little bit of a strange way to explain it. But anyway, you get the point that technically this looks like it's heading lower. The dollar is smoked. So, right, these are probably, in terms of the long run, good in some ways, right? So that's another part of the case that can be made that way. But in terms of where we really are now, I don't think you can say confidently, with all the selling that's going to come online, with the selling that hasn't been done yet, that, hey, this is definitely a bottom yet. And I'm not saying you rule out a relief rally, but from what I've come across over the course of time, usually after three horrendous sessions, and we're only one session away from another horrendous session, should one transpire, usually that's how these sell-offs end. It might not be the end of selling, but it could be a temporary oversold basis where things are horrendous, and then it's so bad for 3 consecutive sessions that you finally do get some buyers to step in. And so that's something else I have to throw out there. So you've got to be prepared for that. I would say if they gap this thing lower on Monday, um, I hate to say this, but I have to start thinking about buying something. Not because I'm thinking it's the bottom, although I would hope it would be, but I don't really have high confidence in saying that until these problems get resolved that we've got right now, these news issues. But I would say you get a third massive, down candle with the kind of ugliness we've seen, then you almost have to start looking for signs of bottoming action. Or if you don't see many, but just see a glimmer, just have an itchy trigger finger on your hedge or your exit, right? But at some point, if you start to see uh, some bottoming signs where the selling seems like it's abating, right? And there's kind of like short-term exhaustion of selling, and you almost see where stocks are just not being sold relentlessly. That might be a sign that we've gone a little too far to the downside, a little too fast, and that they might start making some hay out of it. So on that note, I did add some other levels here, I think, that are important flatline levels. And so if things do continue to unravel, you've got 474 along with these fibs that I'm leaving in place. So you've got all the fibs here that I would chart with, and you've got this flat line right here, and you're near that 500 and you're near a support lines that's pretty big. You have gone below there, but remember, going below these things or just above them is something that the gang does regularly, which is why trying to use precise points for trend lines is tough in real time. And you look back on them and you're like, wow, that was actually pretty good overall. But yeah, if you're trying to be super precise in real time, it's hard. So it's kind of a general vicinity thing. You did get a little bit below there. They could maybe start putting up a fight with based on the fact that you're below trend and you're also below the 500 day. We'll have to see. I have the sense with this kind of ugliness though, it's almost as if there should be one more session. It doesn't have to be. That's usually been one of the key tells from my recollection as to when the market might have a short-term bottom that you can trade. But given what our projections were, given that we plunged right through our 511-ish, which was the low part of our 511 to 515 range. That got shredded. Not normally a good sign. Heading to your next fib puts you at about 487. And then you're near my flat line as well. And you get after that, you get close to the 1000 day down here, and then you get to your next fib, which is the 78.6. But obviously, 61.8 doesn't get much more fibby than 61.8. So that's something to think about because uh, these things can be pretty reliable. You can see different, especially if you can connect other factors, which is what we try to do. But big picture, it's worth looking at the big picture, and then we'll move on. Big picture, right? If you think this is really something more than just an ordinary sell-off, which it does seem like it has signs of being, then yeah, you could really fall quite a bit more. But as always, I would take it incrementally and just keep evaluating. When you get to another level, you just keep evaluating and try to be nimble. I think that's the best you can do because it could conceivably slide right all the way down to some crazy low level down here. But at the same time, we know that often, right, you have something even if you have large corrections or bear markets, usually, right, they have back and forth to them. It's not just all down straight. And but I don't once again, I would hasten to add, I don't know what news is on the way. And that's why, again, I think it's sort of folly to sit here in the midst of something like this, and for me to act and kind of pretend that I've got the answers during something that's this news driven, this potentially volatile. I think that would be very foolish of me to do that, and I don't think it would serve anyone well that again endures these videos week in, week out. But yeah, so I'm going to stick with uh, go stick with these fibs, stick with these flat lines, stick with those SMAs that I threw in there. We're looking at big picture stuff. And I would say that the other problem you got is that these gaps, and I've labeled some of them, and I know you don't even want to look at them, and neither do I really, but you've got some gaps that just were never filled. So if it gets completely insane in this year at some point, uh, that might be generational buying opportunity. I would think if you really get another, say, 40% corrective factor, which would almost double, well, more than double where the spies have fallen to, I feel like you have to be at least be DCAing, dollar cost averaging at that point in time. Here is the Qs, and I'm just going to say that if you look at the Qs, I left these a little bit cleaner in terms of where's my cursor? Uh-oh, cursor's sorry, I'm just man. So cursor found finally, and we're at a level that's sort of been right. A big low is put in right there, and that's where they stop. But they are below the 500-day there on the daily. There's the 1,000, and there's that longer term support line, trend line that I've got in there. There is a gap here that's fairly prominent, and that all comes in. And I hate to say it, but you can see where my cursor is on the other side. Like that's way down there. There's another one here. There's another gap right in here. This one may be more, I don't know what happened to my oval. I thought I had one there, a little white oval, but that might be more relevant. That comes in at 380. So you've got a lot of things. We got the 1,000, you've got your long-term support line, and you've got a gap fill all bunching up there. I did add some flat lines, and you ought to be able to see those levels that I think if they could matter if there's further descent here. Let's look at the big picture on this. Here's a quarterly chart of it, right? And you can see that the reason I have these long-term support lines is just to show that in the long run, you still haven't cracked your long-term trend, right? So as bad as it is, and I know it is, you still haven't cracked it. And that's good, right? If you start cracking that, geez, but we could still get quite a bit of drop clearly from here. And that would be almost, not quite, but almost another 10%. So that would be before you get to really where there's bigger support. So anywhere between, I guess you could say, realistically, though, it's anywhere between about 5 and 10% lower if they decide to take it there. There's gaps that could be filled that are even worse. Here's a different view of it on the monthly chart. You can see where it all comes in. But I do think because markets often return to where they broke out from or where they topped out before. That's why I've got those lines in there, the 385 and the 402 on the Qs. Now, again, if it gets a little worse than that, you may come in. This is where I would think they try to bring it in. So let's get rid of this. I'm going to just put a fib on there for us. I thought I might have moved that or done something by mistake that shifted on me. But let's go to here. And then let me just switch over to weekly to get a better view. And I just want to, excuse me, be able to dial these in from the this leg of the bull market we've been in, and the 540.81 is our high. And then let's get the low right there. Man, 254.26. 254.26 is our low. And this sort of give us fibs we can maybe add on to work with. And so what the fibs have done for us is to tell us that the 50% retracement since the lows that were put in a few years ago that really launched this latest leg of the bull market, that is at right near 50% is right near 397, which is near the 402. So that would be probably a pretty good zone of where you would think if they do drop these things, it comes into further. The next one is clearly the 385. 385 and this support line come in there. And then the next one down really probably is your 363 at the 61.8 retracement. So I'd still think you're in an uptrend for now. I know it doesn't feel like it. I'm just saying that I don't think all hope is lost that there's really, let's say, super historic stuff on the way. It seems like there's still hope that you could pull out of this, get a really strong, obviously, corrective phase that we're in, and then you still maintain things. But we'll have to wait and see. We'll have to see when we get there. The Qs, on the other hand, um, they were obviously the laggard. We kept hoping they'd finally ignite and that rates would come down and then they would start to pick up and policies would shift to help the smaller companies. But unfortunately, that never materialized, and a lot of that breakout potential we talked about for so long was annihilated recently, unfortunately. So it's been pretty bad in there. There's the big picture view. What I did on this one was just add a couple of levels that the next few flatline levels that are, remember, these are not super precise. These are basically ballparks where I think there's going to be that kind of flatline support that existed in the past. You could see obviously the 163-ish one here, that has to stick out to your eye because if I extend it even, you can see a lot of candles even further back here are right. They have opens, they have wicks, they've got closes, right, all right near there. So I think that's a good line. The 171 also, 171 is also pretty good. So that's a zone I would think where there's a good chance that some support would be found in there. Again, with news being what it is, don't know what else you could say, right? Just because things could really, from there, things could really, excuse me, fall apart. But this is clearly retracing nearly everything, of the move that it had the last couple of years. And it didn't have much of a move really to write home about, unfortunately, comparatively to the other three major index ETFs. Here is the diamonds. This should be marked up. I was going to say I don't know what happened if it wasn't, but I did mark this stuff up. Let's go to weekly to get a better view. I've got some gaps labeled in here. I don't even want to go into them all because they're kind of dismaying. Like I don't want to talk about how many unfilled downside gaps remain. And my experience is when has been that the chance they have their best chance of being important or whatnot when things are really falling off the rails like they are now, sort of. So here's here's the diamonds. Uh, let's look at this one. I think at this point, this 378, you're not very far from there, right? So that's really just down a little bit from here. That would clearly be a flat line in my book, flat line support. The next level down on that is about 353, 354, where there's another flat line. So unfortunately, if it doesn't hold here, then you're probably inviting a lot more, relatively speaking, on the downside. You're inviting a lot more out of it. That's very unfortunate. So here's the 500 day we're this kind of tangerine colored line. You're near there. You're getting close to the 378, but you could see someone might make the case. Well, there's a little bit of flatline support near 371. Yeah, there is, but I don't think it's as stout or should be as stout as what happened here with these tops, the retest, and then this double bottom here that really formed there and sent this on its way. But this is this is just like everything else. This is super oversold. But unfortunately, if all hell breaks loose for whatever reasons, there's big time gaps that remain unfilled. Goes way back. It might be even just pennies, but in theory, gap theory, that's some people are going to be sticklers and say, well, it never really completely filled. I'm going to say, and I often do, in real time, I would just say, look, it kind of filled in spirit if it got within pennies and you're talking about something that trades as high as this does. But technically, no, it really hasn't overlapped. So I gotta say, technically, I can't disagree with those folks that are sticklers. But in real time, when you have this factor and this situation happening, this is when these gaps tend to somehow get closed. And so there's even one really down in here. It's crazy how many were still out there. But again, I wouldn't obsess over that. I think that gets you too far out, gets you too worried. And I think you just got to try to take it day by day, hour by hour, and go from there. But clearly, all the stuff that was, I think, building and uh, all the things we talked about and tried to warn about. Unfortunately, it looks like a lot of that stuff ended up mattering, including the NVDA deterioration story and the leadership concentration and the valuations and the uncertainty, disruption. All of it seems to be maelstroming this market right now. And you mix that in with uh, the housing market that was sort of manipulated that Ryan's been covering, the uh, the the defaults or delinquencies on so many things, credit cards, autos, so on and so forth. The job issue, the Doge recession that Ryan's covered a lot. He's been talking about that, and he's been, in the forefront of kind of talking about how that's going to hurt things that, maybe if you're maybe just it's long run, if your government's wasting billions or hundreds of billions or trillions or whatever the case may be, if that's all legit, what's been found, clearly eliminating that is a good thing in the long run. But in the short run, without that cash flowing the way that it has apparently for quite a while, yeah, that's gonna be a liquidity drain, and it adds up. And yeah, so anyway, that's where that is. But here's your 1,000 day down here, um so that you got an idea where those are right now that are highlighted by the software. But yeah, I think you got to be really careful, and just not get locked in. I just as I said, if they have one more really horrendously ugly day, especially if they open down badly and then they go even lower and you just see nothing but selling, usually there's you got to start looking for a tradable bottom at that point. Three horrendous sessions in a row often leads to a a decent bounce, a decent relief rally. That's been my experience, and that's what a lot of people, I think, will. I haven't looked, but I'm guessing a lot of people are going to put that out there if we get real ugliness happening on Monday, or maybe they will over the weekend out there on X. But um, that's the thing. It would almost be better if we did. I hate to say it because I know a lot of people don't want to see this market fall even more. But if it did fall even more, it probably wouldn't be the worst thing, because then you might get a lot. If you get that kind of ugliness, you might get a very forceful trampoline bounce because you've fallen in such a cascade style, right? You just really have fallen. It's such a negative, nearly vertical slope. So you don't usually get that much of that, and probably some people will start coming in nibbling. But I think the big reason why I'm just can't be bullish yet is there's look where you ended up the week. As we said at the end of the first quarter, the end of the third month, we didn't like the way the monthly charts flipped over. They were horrible. That was not always the biggest problem, but not what you want to see when you already have growing concerns. And now you have a really ugly close here. Mondays have produced a lot of ugly days that have turned into great tradable lows. That wouldn't be the worst thing that would happen, because that would at least give us the potential for a nice relief rally. And obviously, if things were to get completely battered, they have a lot more springboarding they could do, given the gaps that were left on the way down now. So that would be ideal. But I don't really have much more that I can really add here. Everyone knows the VIX is sky high. It's one of the highest closes we've seen in a while. We know the sectors are terrible. We know breadth is terrible. We know sentiment's terrible. We know that oversoldness is terrible. We know that this was a historically horrendous day. You don't see too many that are this bad across the market. and we know that risk off is dominating. So with all that, it's really bad. But I think, yeah, the other review is, I think when some of the things, and you just can't know this from week to week, but we kept saying, what's going on with transports? Why are they not why are they not behaving? Why are they not doing better? XLF was doing better for a while, and then that started to falter. And so when some of the important sectors and the leadership sectors like XLK and XLC, when these things along with SMH started to really struggle, that's when you've got to say, I'm willing to cap a little bit of upside right now, just to be a little bit safer. And in my book, and then if that starts to fix itself, great. If you miss out on a little bit of money when things are repairing themselves, once again, I don't think it's the end of the world. You just got to live with it. Say I forewent this for that, but I didn't get taken to the cleaners. So on that note, I'm going to wish everybody a good conclusion to their weekend. I know it's a very tough market to trade in right now. I hope I feel better by Monday morning, and I can do a better job for everybody next weekend with a more extensive video that's not just stream of consciousness. But I really don't think I could add anything that's going to be earth shattering to this is why you need to buy now, or this is why you need to keep selling, just because you're already so far into this move. So do you want to be a massive seller here? I don't know. I might hedge, but I don't think I'm bailing at this point. I think I would just hedge. And again, if I lose money on my hedge, then that's okay. I'm okay. I'm willing to deal with that so the market gets on better footing. If I don't and I protect myself, then I can live, I'm happy I did it. So I would maybe hedge. The unfortunate problem there is that volatilities are really high, and that's probably why you don't want to be a put buyer. You might want to be a synthetic put seller in the sense that if you sold calls against your long stock or long calls that are out further in time, as I showed earlier in the video, that simple trick will kind of let you neutralize. And you don't have to go 10 for 10, by the way. You could just sell 8 in the front week or front month, depending on how long dated your long calls are. You could sell 9. You could try to just neutralize the delta or just keep it so that if it goes back up, you don't lose too much. Maybe like 10 versus 8 or 10 versus 7 on the short side. So just think about it. Talk to Ryan, talk to Greg, talk to Bill, talk to the other guys like Scott and Stu, and they can get you dialed in on this simple approach that in the heat of the moment will let you neutralize your risk and step back, evaluate, and think things through. And that's not the worst thing, even if it costs you a little bit of money beyond commissions or whatnot. So everyone, y'all take care. I hope this video helps you this week or some week in the future. And I'll be in touch hopefully next Friday with better arrangement, better video, and all that kind of stuff. Thank you.